Hello, Uncle Jim here. Today I want to share with you one of the greatest ways to make passive income, and that's selling covered calls. I've been selling covered calls for probably over 13 years, and I've done quite well with it. This month, I've actually had one of my best months. I've done, I think, 8 or 9 trades and done a little bit over $2,000. I'm going to share with you at the end of this video those trades and also go into some details about my strategies, what works, what doesn't work. So stay tuned. I think you're going to really enjoy what I have for you. Okay, let's go ahead and get started. Now, I do like to kind of give a quick market update at the beginning of most of my videos. I'm not going to go into much detail. I think it's been kind of a topsy-turvy week. It's been down the market's been down most of the week. It's up today. And I think we're going to continue with that. I did notice that GDP was lower than what they expected. So I think we're going to kind of continue with what happened this week, next week. I think we're going to have days that are up, days that are down. I think we're still going to be trending probably more down than up. I do think the Fed is either going to increase one more time or not increase again. I think the consensus out there is that they are going to increase 1.25%. I'm not so sure. It's kind of a wait and see. I believe they're going to make an announcement coming up soon, maybe as early as next week. So at least that's my 2 cents. And as always, it may only be worth 2 cents. Now, I've been, like I mentioned in the beginning of the video, I've been selling cover calls for a long time. In my mind, it's probably the safest, if not one of the safest strategies. You could argue maybe that cash secured puts are also just as safe, but I don't know. I started with cover calls many years ago, and that's all I did. And I really didn't know what I was doing. And with not knowing what I was doing, I still did pretty well with them. So it is a very safe strategy. And let me just give you a quick 2-second idea of what a covered call is. So if you own some stock, and especially if you own 100 shares, and I'm going to use Cisco as an example, and say you own Cisco at $45. I believe it's right around 45, 46. You can actually sell the opportunity to someone to buy those shares from you, and they will pay you a certain amount of money. And what you can do is you could say, well, I'm willing to sell my $45 shares. That's what my cost basis is with Cisco. I'm willing to sell it for $50, and I want to earn $100. So I could actually sell a covered call using a strike price of $50, and I could look at different expirations. And depending on how far I go out and the strike price I choose, I can earn premium selling that covered call. And it's called a covered call because you already own the shares. So if you didn't own the shares, then it would be called a naked call, which I don't do naked calls. I primarily do covered calls, so I own the shares. So if it gets called away from me, I already own the shares. So in the sense that it's another way to earn passive income, to bring in extra money. And it can bring in quite a bit. Like I mentioned earlier in the video at the very beginning, this month alone, I've made $2,000 just selling covered calls. That doesn't include cash secured puts or dividends or anything else. Just selling covered calls. Just this month, I've brought in $2,000. And a lot of people will say, well, those aren't complete yet. You just sold the cover call and brought in the premium. But I haven't had a cover call assigned in probably 2.5 to 3 years. I had several that were assigned away from me when I didn't know what I was doing. It was part of the reason I got into this or set up this YouTube channel and my associated blog. I really wanted to learn the right way and share with others how to do it. So, and again, what's so key with selling these covered calls is picking the right price. So for me, I typically look at what price I'm willing to sell these shares. Again, Cisco, what price I'm willing to share them. And then once I determine that price, I'll use what's called delta. And delta is one of the Greeks. I have other videos related to the Greeks, but the easiest way to think of delta is the probability that it will be assigned away from you. So I use what's called the 20 delta. So it's like a 20% chance it would be called away from me, or an 80% chance it'll just expire and I can keep the premium. And that's what typically happens probably to most of my shares. I either close them or they expire, and I'm able to keep the premium. So those are kind of the two key points is, again, the strike that you want to use, as well as picking the right price. I don't use delta without thinking through what I'm willing to sell it for, and I also like to keep it above my cost basis. So if I purchased, and again, I'll use Cisco at 45, I'm not going to be selling calls at 45. I typically will do it above my cost basis. Now, that doesn't always occur. You might have, like, I also own Intel, and Intel has gone through a rough time recently. So I am selling some Intel below the cost basis, but Intel's significantly below that strike price. So I am fairly confident that I can roll it up and out. And you may be saying, well, what does rolling mean? That doesn't make any sense to me. But rolling is just simply closing your current position and opening a new one. And in the process, you end up bringing in more cash from your new position that pays for closing your old position. So you end up with a net credit. And that's one thing that I end up doing a lot. You'll see again at the end of the video when I go through my spreadsheet that a good portion of those were actually rolling covered calls up and out. Another important thing that I like to use is I don't try to make too much with my covered calls. One of my goals, and it's been talked about not just with this channel, but other YouTubers who sell options talk about it, is doubling your dividends. So if you're making 3 to 4% on a stock with the dividends that stock buy or shares or pays, I try to double those dividends by selling the calls or the covered calls. So to give you, for instance, if it's 3.5%, then I try to pick up at least another 3.5% by selling covered calls on that stock. So in a sense, doubling, from 3.5% to 7% or 4% to 8%. And I've been able to do that pretty regularly. So again, if you're someone approaching retirement and you're looking to live off your portfolio, selling covered calls, and you could just sell covered calls. You don't necessarily have to do other strategies. You don't necessarily have to do puts and, more complex strategies. You could just stick to covered calls and do quite well. I also calculate the return on investment a little bit different with covered calls. I, again, typically use the cost basis of what I paid for the stock, and with the return on investment, it's typically lower. You could do a little bit, or you can do a lot better potentially with puts, especially vertical put credit spreads. But the fact that you're using a much higher value, your return on investment on a yearly basis will definitely be lower than what you see for puts. But it is, that's where it makes it easier to compare to the dividend and then to see if I can double that dividend. And a lot of times I do better than double. Sometimes I'm able to triple it. So I'll get a 6 or 7% yearly return selling a covered call, and that stock may only pay a 3.5% to 4% dividend. So again, that's one way for me to measure it and to determine, is it worth making this trade? Because a lot of times you'll get into the trade and you're like, well, should I go ahead and make it? Am I making enough money? So by using that strategy of doubling your dividends, it gives you kind of a starting point, to know that, wow, I'm making enough money. I can go ahead and make that trade. Another important point is with the bear market, when the market's going up and down like it's been going lately, a lot of times selling both puts and calls can be really profitable. So to give you for instance, I sold a lot of calls back in January, and then the market, I believe, went down some in March. I think it went back up early April, and now it's back down. So as the market moves, so does the profitability related to your call. So a lot of my calls ended up becoming very profitable, and I was able to close quite a few. And then now when the stock is back up again, I'm able to sell more. So the point that, we're kind of in this topsy-turvy market, selling calls and selling puts, you can kind of balance things out. If the market's up quite a bit, then you can sell calls. If the market's down, then you could sell puts. And you can also look at profitability. If the market's way up, where your puts may be very profitable, and vice versa. If the market's down quite a bit, then your calls may be very profitable and you can close them. So at least that's something I found that's happened quite a bit for me. So balancing, it kind of balances out. Like this month, I believe I've done pretty near the same number of trades. So I think I've done 8 or 9 calls, and I think I've done 8 or 9 puts, which typically happens. It's become more the norm recently. One thing I did want to mention that I have forgotten to mention in previous videos, if we do get to a low point, and we have seen some of that with some of the stocks, you could also buy calls. So if the stock is something you really want to own, you currently don't have any shares, and you really want to potentially buy it, you could buy a call versus buying the shares. So to give you for instance, say Cisco goes down to $40, you could buy a call at $40, say 3 months out. And that means if the strike goes below or above that $40, you could call those shares to you and find it, a way to own them at a really good price. That's something I've forget to do. I haven't done it much myself, but again, if we hit new lows back in October, I thought about doing it and never did it. I could potentially, buy some calls on some stocks that I really want to own. An example might be Apple. If Apple again approaches the low 100s, it would be a great investment. And the same thing even with Google. If Google gets back down into the 90s or something, I may look at buying a call for it too. So it's just something I wanted to add, something I've forgotten to mention in previous videos. And then finally, and I'll talk more about this when I go over my trades, managing your positions really makes a big difference. When I was first selling covered calls, actually going all the way back to about 3 years ago, like I said before, all I did was let them expire. And for the most part, they mostly did expire until I believe in 2020, I had 4 or 5 contracts of Coca-Cola get assigned to me. And I was like, man, what am I doing? I'm definitely doing something wrong. And that's when I started to learn more about options and how to manage them. And when I say manage, I'm talking about, I keep a note of all my trades. I put out a planning worksheet that I provide to my memberships. And of course, if you want to learn more about my memberships, take a look down below. I'll have links so you can find out more. And as always, please subscribe, hit that like button. But it's given me the ability to kind of learn how to work with these trades. So in the sense of covered calls, if the price of the stock goes above what your strike price is, you don't have to let it just get assigned to you or expire. You can manage it. You can close it, or you can roll it and look for a higher strike price and get it out of being in the money. And I find I do that a lot. So, and by using a planning worksheet and tracking my trades and keeping an eye on them, it's given me the ability to really manage them. And I'm pretty rarely ever caught by surprise. The exceptions are dividends. Now, one thing that can happen when you're selling covered calls, if it's anywhere near the money or in the money and that company is paying a dividend, that can impact it. So you have to keep track of ex-dividend dates to be sure that you're out of the money. So you want to trade, roll that covered call up to get out of being in the money if it's near a dividend date, because a lot of times you will be assigned right at the ex-dividend date or the day or two before the ex-dividend date because people want to own it in order to get that dividend. So that's one thing too in my spreadsheets that I try to remember to check, which is the ex-dividend dates. When is the company actually declaring that if you own the stock, and an ex-dividend date is literally if you own the stock on that date, then you will get the dividend. So that's why you would need to potentially trade before that ex-dividend date. So, and that's one of the things I found, again, related to managing my positions, especially related to covered calls. But I found pretty much managing covered calls, it was a lot easier than I ever thought. So I've been able to, like I said, in the last 2.5 years, I don't think I've had anything assigned to or away from me. And I've been able to avoid, some situations that would have been assigned away from me. So with that being said, let's go ahead and jump into the spreadsheet where I'll share with you the trades that I've done in April. And I'll go into a little more detail on why I did those trades and a little bit more about the company. So stay tuned. Let's jump into that next section. Okay, I've opened up my spreadsheet. These are the 9 trades that I did. These are all covered calls. I've also done a lot of puts, but for this video, I'm just talking about the covered calls that I did. And let's just kind of jump right into it. Here at the top, you can see I've done 2007 just on covered calls this month. The first one I did was Cisco, and this was a roll. And I rolled it. The strike price was $52.50. It was expiring on 4/21, and I rolled it out to 7/21. So I went out 3 more months, and I upped the strike from $52.50 to $55, and I picked up $148. Here's the cost basis, and it was a yearly ROI of 5.8, which more than doubles the dividend. I believe their dividend is like 3.5. So Cisco, it's done really well for me. I've done well selling puts on it. I've also done well selling calls. If you don't have it, it's not part of your portfolio. You should seriously consider it. It's a good company, well managed, and it doesn't move much. It stays between that $40 to $50 range. Next is BP. I've done really well with BP, just like Cisco. I believe it's probably, I had it put to me last October, and I think it's up 30-40% from that point, and I've been selling cover calls on it ever since. So it was expiring. This is another roll. It was expiring April 21st. At that point, the current price was $40.30. I rolled it up to 41, so I went from 39 to 41 and went all the way out to October, which sometimes I will. I believe BP didn't have as many expirations. But again, I'm sometimes looking to get just enough of a return on investment to make it worth my while. And here I actually picked up $265, and the cost basis was just over $6,000. I brought in over 8.5%, which I believe doubled the dividend rate, which again is what I'm looking for. BP is another good company. I like it because it's not as expensive as ExxonMobil and some of the other ones like Chevron. So I've been working with it, and again, it's done quite well for me. TFC, this is it got hit. It's the bank I use. It's Truist. It pays right now because of where it is. It pays a really good dividend. So it was assigned to me soon after the banking crisis. I think I picked it up. We'll look at the cost basis. So this is a new cover call. I did it with a short strike of 40. It was currently at 33.48, so pretty far outside the money. And I did go fairly far. I went, I guess, almost 6 months, but I brought in $300. And I believe when I sold it, it was one of those really crazy up days for it. It's the whole banking industry has been going up and down quite a bit. So my cost basis is $87.17. So I think I'm like 20-30% down on Truist when it was assigned to me. I believe it's now showing like a net loss of 22%. But the $40, I believe, is right pretty close to my cost basis, maybe slightly below it, because I believe it's 2, so it'd be around 8,000. So it's a little bit below it, but it did bring in 8%, and I'm pretty confident I could roll it again up if need be. So, but it brought in $300. It's an 8% return. I did go a little farther out, but again, the fact that on a yearly return basis, it's over 8%. Now they are paying a really good dividend. I think it's close to 6%. So it did more than double the dividend, but not by much. Next is LEG. This is another beaten down dividend aristocrat. It's at a really good price in the low 30s. I wrote a covered call on it. This is also a new one for $35, expiring 9/15. So again, I went a little farther out. The current price was at $31.51, and I believe this is fairly close to its 52-week low. And I brought in $182. The cost basis was $73.99. So Again, just below the cost basis. If it does get up into the mid 30s, like it goes above 35, I should be able to roll it out and up. And I picked up a 5.7 yearly return on it, again doubling the dividend. And because it's so low, trading around 31, 32, I believe it's still trading around that amount. It's a good stock for small accounts. It's definitely, I did fairly well with it selling puts on it, and then now I'm doing fairly well with selling covered calls. Next is 3M, again another beaten down company recently. Now they do have a lawsuit. If you invest in them, be sure to do your own due diligence. They were assigned to me back in October. This is a new covered call for 115. It was a 17 delta. Its current price was 106, so 115. It's still fairly far out of the money. And you can see here the cost basis. This is one of the exceptions. I'm definitely under my cost basis. So it would be 11,500. So I'm almost $1,000 underneath my cost basis for it. But like some of the others, I do think I could roll it up, but I could get in trouble with it if it suddenly starts jumping. Now, actually, I believe it's gone down. I believe it may be as low as 104 now. But I did 6.5%. Now, that just barely doubled their dividend. They have over a 6% dividend, which is really good. So again, 3M I think is a good company, but hopefully they'll deal with that lawsuit. Before too long, they'll make a deal with the government and it'll work out okay, or work out in their favor, or not their favor, but in both the military's favor as well as their favor, so that they'll continue to exist. Now, PG, I've owned them a long time. So this was a leap. Now this is a covered call leap, and a leap is anything that's over a year. I forget exactly what LEAP stands for, but typically it's any kind of a options contract that's over a year. So this one I went a little farther out. PG had a resurgence. I had the original strike was at 150. It was currently at 156. I think it may be as high as 158 now. So I rolled it. I rolled it all the way out to 117, 2025, but rolled it up to 165, which is above its all-time high, I believe, or right there at its all-time high. So I don't think it'll reach that. But if it does, I should be able to roll it again. And it's fluctuated. If it drops down into the 140s again, then this contract should become very profitable and I could probably close it early. But you can see here, I brought in $348. So again, leaps are a great way to make some big bucks on a short period of time, especially if you own a bunch of shares. I think I have 200 shares in PG, so I don't own a lot of it. But if I know other people out there who may have worked for Procter and Gamble, they may have quite a few shares. So doing leaps can bring in a lot of money in the short term, but you have to be careful again, because you could end up doing potentially 4 or 5 covered calls in between, that longer time period. You could do 5 3-month covered calls versus one long one. And I tried to do that originally, but I couldn't find much premium. So that's why I went a little farther out, and I didn't want them called away because I really have done well with Procter and Gamble. And you can see here, my cost basis is 4,200 and it's currently worth 156. So you can see it's significant. It's done really well long term, and I definitely don't want to lose it. So, and the yearly ROI, and again, using this longer expiration, is still a 4.8%, which I believe matches their dividend. It may be slightly above it. So again, I was able to double the dividend, or at least match the dividend. In a sense, that is doubling the dividend. So again, PG is a really good company. I've owned it probably 20, 30 years. Southern Company, another one I've owned a long time. This was also a roll. I had it at 72.50, and suddenly it's also kind of had a rebound. It was expiring on 6/16, and the fact that it was in the money, and I don't want to lose it because it's also done well for me, not as well as PG or utilities don't typically move as much, but I like them for the dividends and they're fairly steady. But it went up to almost 74. I think it might have even hit 75. So I rolled it out to November 17th. So not a leap, but I did go fairly far out and upped it to $75. Picked up $219, which is really good. And here you can see the cost basis is fairly low. And I picked up a 4.3% yearly ROI. So again, another good company you can work with. It doesn't move much. It's fairly safe to own. Now the next one is another new covered call, and this is BEN, which is Franklin Resources. They're a financial company. I like them. I like some of the products they put out. I've done well. I think I've got they were assigned to me again back in that October time frame, and I believe I have a 14 or 15% return. They're 15% higher than they were back in October. And I did a covered call at $30. They're currently at 26. So that would be like a 15% increase over where they are now. Now their high, I believe, is around 33 or 34. So they could get up to that $30 range and maybe even go higher than that. And I did take a little bit more risk. You can see here it was a 27 delta. But I brought in 148 and the cost basis is 46.81. So you can see what is that, $23, right around $23 for the cost basis. And it was a 6.6% yearly return. So again, another good company. It's not real expensive. I like it. It would work in small portfolios. So something you should look at if you don't currently have it. And it seems to stay in a small range. So it may, if it gets back down to the low 20s, you might want to look at potentially selling puts, because I did pick this up using the wheel and I'd been selling puts on it for a long time. Then it got assigned and now I'm selling covered calls. So a definite wheel strategy scenario with BEN or Franklin Resources. Now Micron is interesting. It's another stock that was assigned to me. It's moved quite a bit. It's been hurt a little bit more by earnings recently. It's not doing quite as well, but it did have a pop. It did go up quite a bit one day. I think it was up 4 or 5%. So I was able to sell a covered call on it at 70. It's currently at 61. So I'm not too worried. At 70, I believe it's fairly profitable for me. I think it's about break even currently. That was the original one. This one I did roll. Did I put new? No, I put roll. So I rolled it. Let's see. I rolled it out to 7/21/23. I believe it was expiring on 6/16, so that's incorrect. I rolled it out another month, a little bit over a month, and picked up $70. Not 70, that's the strike. I picked up 177.40, and here you can see it was right around $60 a share that I picked it up. So like I said, I'm about break even with it. So 70 would be a nice gain for me. But the 177 was like a 6.3 yearly return, which worked out really well for me. And it's a company. If you want to invest in it, you need to do your own due diligence. It's struggling a little bit because of its earnings, but it could have a rebound. It could jump significantly depending on what happens. I do believe they're projecting next quarter they're also going to have bad earnings, but then I think going into 24, things are going to look a lot better for it. So definitely do your due diligence if you're not quite sure about it. Before I go into these numbers, let me jump over here. So again, I did 2007 and just covered calls. This averaged to 233 per contract, or not per contract, per trade. So again, a lot of these I spent hardly no time on, maybe 30 minutes per contract or per trade. And a lot of that relates to I share these trades with my memberships. So probably half that time was sharing it with my memberships and posting it on Patreon and giving details about the company, why I like the company, or concerns I may have about the company. they're considering actually selling a put on it or buying it in particular. So I had 5 rolls. So again, majority of them were rolls, 4 new calls, and probably most of those new calls were ones I had closed when we had a downturn in the market. So when the market dove, a lot of those became really profitable and I was able to close them. And now I'm able, again, because the market has gone up in April, I was able to actually sell more covered calls on those particular companies. So, and then I just wanted to share here. So here, April's typically one of the best months I have for dividends. So I brought in over 2,500 in dividends this month because more companies pay their dividends in April. And then this is the cash flow I've had this month just for puts. And here's the cash flow for calls. And then overall, between the puts, the calls, and the dividends, over $6,000, which is given me the ability to be financially independent. I've had some big bills this month, so this has worked out really well. We've had some health issues, and I've had to spend quite a bit of money. And if I hadn't had this going on, I'm not sure where that money would have come from. So just wanted to share that. It's and especially with the covered calls, again, I believe it's one of the least risky type of trades that you can do. Again, because you're picking the price you want on the stock. And I've seen people actually, I've followed some other YouTubers that will do a 10 delta, and I think they've only had hardly anything ever get assigned. With a 10 delta, you're picking a much higher price. And if you're using value companies and not using, companies that move drastically, you're very, very protected. Very unlikely that stuff would be assigned away from you. So hope you enjoyed that. Thanks for joining me, and I hope you have a wonderful day.